Hello everyone. We are going to solve cost of capital question from March-June 2021 attempt. The first requirement is using the capital asset pricing model, calculate Z company current cost of equity and project specific cost of equity suitable for the new venture. So you need to calculate two cost of equity, the current cost of equity and the project specific cost of equity. Obviously, in current cost of equity, you will use the current beta, but in project specific cost of equity, you need to calculate the new beta by ungearing the proxy company and by regearing with your capital structure. Referring to your calculation above, comment briefly on the view of the commercial director. Zeddemore company is a listed company in the housing construction industry. Over the past 5 years, results have been disappointing. As a result, the share price has fallen from a high of $3.5 to only $1.05 per share today. This deterioration in the performance and share price has been accompanied by an increase in financial gearing to a high level. So companies facing two problems. Gearing is rising and share prices are declining. Share capital is 0.5 is the par value, 40 million is the book value. So if we divide 40 million over 0.5, 80 million are the number of shares. Retained earnings are given 35, 6.5% irredeemable loan notes are given, 250 is the book value. 7% bank loan is given, 20 million is the book value. And remember, the market value of the bank loan and the book value of the bank loan both are same. Zeddemore loan notes are quoted at $65 per loan note, and both the loan notes and the bank loan are secured. Company current equity beta is 2.3. New venture. To improve performance, Zeddemore company is considering the construction of a commercial property such as office blocks and industrial complexes. This is a new activity for the Zeddemore company, and it is expected that risk involved will be different from its current activity. So you need to identify a proxy company. You will ungear the beta of proxy company and then you will regear it with your own gearing. The financial director has proposed that a project specific discount rate should be used to appraise a new venture, but the commercial director does not believe this is necessary. WCP undertakes commercial construction projects similar to those being considered by Zeddemore company. So this is a proxy company. Remember, if you are confused in exam, any other company which is given should be the proxy company. WCP has an equity beta of 1.25, 100 million of ordinary shares in issue. Currently, market value is $2.6, par value is $1. Company also has $110 million of loan notes and its market value is $96 and the par value is 100. Both companies pay tax at 20%, risk-free rate is 4%, and the market portfolio return of the market is RM. Return of the market is 10%. So let's calculate the current cost of equity. Current cost of equity. Risk-free rate is given. That is 4%. Return of market is given 10%. Beta is given 2.3. So cost of equity is equal to risk-free rate plus beta into RM minus RF. 17.8%. Now let's calculate project specific cost of equity. First of all, we need to calculate the proxy company. So I'm assuming that Winston commercial company is suitable proxy company. Ungear beta equity of Winston Company to calculate beta asset. So beta equity is given, that is equal to 1.25, and its equity is given, that is 100 million shares into 2.6 market value, and debt value is given, that is 110 million into 96 divided by 100. So let's calculate beta asset, that is equal to beta equity into equity divided by equity plus debt into 1 minus t, that is 0.8. So 0.94 is a beta asset. So now what we will do, regear this beta asset using gearing of Z company. So beta asset is given. Let's calculate the equity. That is equal to 40 million over 0.5 into 1.05, 84. And let's calculate the debt value. There are two types of debt. Irredeemable loan. It has a value of book value of 250 over 100 into market value is 65, and bank loan is 20 million. So that is total 182.5. Now let's calculate the beta equity. That is equal to beta asset into bracket start equity plus debt into 0.8 over equity. 2.58 is the relevant equity beta. So now let's calculate the project specific KE. So that is equal to, let me copy the risk-free rate and the RM, but obviously beta has been changed now. So KE will be equal to risk-free rate plus beta into RM minus RF. So it is equal to 19.5%. So this is the suitable answer. Now let's discuss its second part. Referring to your calculation above, comment briefly on the view of the commercial director. Remember, financial director was saying that company should use the project specific discount rate. However, commercial director was saying that there will be no difference, use any rate. So commercial director is wrong in its assessment. How? Current cost of equity is 17.8%. Project specific discount rate is, project specific cost of equity is 19.5%. This 19.5% is reflecting the risk of the new project. That means new project is risky. That's why cost of equity is higher. So if on the basis of, on the view of commercial director, we would have discounted cash flows at 17.8%, Obviously, if we discount cash flows at lower rate, NPV will be higher. So it seems like project is very beneficial, project is worthwhile because NPV is higher, but the actual cost of equity is 19.5%. The according to the risk of the project, according to the actual risk of the project, actual cost of equity is 19.5%. So if we discount cash flows at 19.5%, obviously NPV will be lower. So by choosing incorrect discount rate, you may have selected the wrong NPV project. So that's why ignore the view of commercial director, calculate project specific discount rate and discount cash flows on the basis of this project specific discount rate. So you have to write this briefly here, and if you type your answer here, do not type in a single row. Type your answer like in 3 to 5 cells of first row, then 3 to 5 cells of second row, then 3 to 5 cells of third row, like a paragraph. Do not write in a single cell. You will create trouble for the examiner, and examiner will have to navigate through the cells. So your paragraph should be written in this way, in different rows. Let's move to the next. Discuss 3 problems Zeddemore company may be facing as a result of its high level of gearing. Guys, remember, if company is facing high level of gearing, first problem will be its earning will be volatile. Its earning will fluctuate over the time, because maybe your sales will increase or decrease, but you have to pay the interest. So that's why your earning will be volatile. What is the meaning of volatility here? For example, if company sales decline by 10%, if company sales decline by 10%, remember your earning will not decline by 10%. Your earning will decline by more than 10%. Why? Because you have to pay fixed interest cost every time. And if earning increases by 10%, your earning will increase by more than by 10%, because everything is increases, but your financial cost will remain same. So fluctuation, the earning volatility will increase if you take more amount of loan. For example, a scenario, your sale is 10,000, your cost is 4,000, it's a variable cost, and your interest is 2,000. So your profit here is 4,000. For example, in B scenario, your sale increased by 50%. It will be 15,000. And your cost will, this is a variable cost, this will also increase by 50%, 6,000. But your interest will remain intact, fixed. So earning will be now 7,000. Sale is increasing by 50%, but your profit is increasing by more than 50%. That is the earning volatility. Earning will become volatile if in case of high level of gearing. Similar is the case if earning declined by 50%. For example, if sales declined by 50%, for example, sale has become 5,000, cost will become 2,000, but you still have to pay this 2,000, so profit will be 1,000. Sale has become 50%. Sale is decreasing by 50%, but profit is not decreasing by 50%. Profit is decreasing by more than 50%. So that means earning will become more volatile in case of high level of gearing. Second, if there is a high level of gearing, your financial risk will increase, your beta will increase, your cost of equity will increase. And if cost of equity is increasing, your final WACC will also increase. Third is, if high level of gearing, you cannot take more loan. In case of high level of gearing, you cannot raise any more debt. Your debt capacity has reached to its maximum limit. Fourth point is, if there is a high level of gearing, your company will face bankruptcy cost. Bankruptcy cost doesn't mean that you have become the bankrupt. Bankruptcy cost means your supplier will not trust you, your customer will not trust you, your valuable employees will leave your company, your shareholder will demand higher return from your company. So these are the three problems, these are the few problems in case of high level of gearing. In respect of both equity and debt, discuss the risk and return relationship and how it affects Zeddemore company financing cost. Guys, one thing, always remember one thing, there is a pure relation between risk and return. If there is a risky venture, investor will demand higher return. If there is a less risky venture, investor should demand the lower return. So if you are the shareholder, you are taking higher risk, you will demand higher return. If you are the bondholder, you are taking lower risk, you should demand the lower return. So here, in case of Zeddemore, if company is continuously taking more amount of debt, that means shareholder will face two types of risk, business risk and financial risk. If company keeps on adding debt, there will be high level of financial risk, and the return, the shareholder of the company will demand higher return, because in case of problem, in case of liquidation, that shareholder will not get anything, because all the funds will be distributed to the debt holder. So in that case, shareholder will be demanding more and more return. In comparison with the equity, debt holder will demand lower return, because debt holder have the preferential right to receive interest on time every year. Debt holders have the preferential right that in case of default, they will get the return. Although there can be a risk that company can default on its loan, but here it is clearly evident that debt is secured against the assets. If debt is secured against the asset, that means debt holder will get their money back in case of default, in case of any issue, in case of any problem. So their required return should be lower because they are taking less risk. So it was evident from the calculation. Remember, cost of equity was 17.8%. And the required return of debt holder is 7% and 6.5%. So why shareholder is demanding so much higher return? Because shareholder will get regular dividend after paying the interest, and that was not even guaranteed. It is on the discretion of the company management that they want to distribute the dividend or not. And in case of default, they will get money after all the distribution to the other debt holder and the preference shareholder. So they are taking huge amount of risk. So that's why they will demand the higher return. So it was clearly evident from here that shareholder is demanding more return compared to the debt holder required rate of returns. You have to write this here. Obviously, you will get full marks if you write properly. Thank you so much.